There is a way to conquer a country without firing a single bullet. No armies crossing borders. No tanks rolling through cities. No bombs falling from the sky. You don't need any of that. All it takes is a signature on a loan document. And time. Because time, when paired with debt, is more powerful than any weapon ever built. This is not a theory. It has already happened. Something fundamental has already changed, even though most people are still behaving as if it hasn't. Homes are being bought. Mortgages are being approved. Neighborhoods look the same. On the surface, nothing appears broken. But underneath that appearance, the assumptions that made homeownership feel safe for decades are quietly failing. This isn't a future prediction. It's a present condition. For a long time, housing was treated as a stable equation. You bought a home. You locked in a payment. Over time, inflation and wage growth worked in your favor. Even if things became uncomfortable, the system bent to protect homeowners. Interest rates fell. Credit loosened. Prices recovered. That pattern repeated so often it stopped feeling like policy and started feeling like a law of nature. But laws of nature don't change. Systems do. What's happening now isn't dramatic enough to feel like a crisis. That's precisely why it's dangerous. The pressure isn't coming from one direction. It's coming from many small, steady forces that don't make headlines on their own. Mortgage costs are higher. Insurance costs are higher. Property taxes are higher. Maintenance costs are higher. Wages are not. Individually, each increase feels manageable. Collectively, they change the structure of ownership. Most homeowners still believe the discomfort is temporary. That rates will fall. That policy will intervene. That the system will reset the way it always has. But systems don't reset indefinitely. They shift. And when a system shifts, people who are positioned for the old rules don't lose everything at once. They lose flexibility first. Then margin. Then options. This is how large numbers of people get trapped without realizing it. Not through panic, but through endurance. Through staying in place while the environment around them changes. History shows that when debt stops being a tool and starts becoming a permanent condition, outcomes stop being reversible. Not because of malice. Because of math. This isn't the story of reckless borrowers or bad decisions. It's the story of a structure that worked under one set of conditions and is now operating under another. And once that happens, the system doesn't need to collapse to cause loss. It only needs to keep going. The last time a system shifted this quietly, it didn't start with foreclosures either, it started with an empire that still believed it was in control. The Ottoman Empire did not fall the way most people imagine collapses happening. There was no single battle that ended it. No moment where everything suddenly broke. No final invasion that erased it overnight. For centuries, the empire survived wars, rebellions, and political chaos. What it did not survive was debt that outgrew its ability to control it. In the mid-1800s, the Ottomans faced a familiar problem: crisis without liquidity. War required funding. Modernization required investment. The empire had land, people, and power, but not enough cash. European powers offered loans. At first, these loans looked like help. They funded war efforts. They stabilized the state. They bought time. And time felt like survival. But the structure of those loans mattered more than the intention behind them. The empire did not receive the full value it borrowed. Fees, commissions, and risk premiums were taken up front. Interest, however, was charged on the full amount. That difference seems small on paper. Over time, it becomes decisive. Once borrowing solved one problem, it was used to solve others. Palaces were built. Navies were expanded. Prestige projects replaced sustainable investment. The empire wasn't collapsing. It was functioning. That's what made the trap invisible. As debt grew, a larger share of revenue went toward servicing it. Not reducing it. Servicing it. Eventually, the state reached a point where new borrowing existed only to pay interest on old borrowing. At that moment, power quietly changed hands. In 1881, European creditors formalized control through the Ottoman Public Debt Administration. It wasn't an invasion. It was administration. A foreign-controlled body with legal authority to collect taxes directly from Ottoman citizens. The Sultan remained. The empire existed. But decisions were no longer sovereign. This is what financial conquest looks like. It does not remove institutions. It empties them. And it doesn't require cruelty. Only patience and structure. The Ottomans didn't see it as conquest while it was happening. They saw it as management. As stability. As necessity. By the time it was recognized as loss, it was irreversible. The same mechanism didn't disappear with empires, it adapted, and today it's operating at a much smaller scale. Housing has taken the role that land and tribute once played in older systems. It is the primary store of household wealth. The primary source of leverage. And the primary channel through which debt enters everyday life. For decades, this worked because conditions were aligned. Interest rates fell steadily. Credit expanded. Asset prices rose faster than costs. Even mistakes were forgiven by time. That environment trained behavior. Borrowing felt rational. Stretching felt safe. Risk felt abstract. But housing is not just an asset. It is an obligation that exists inside a system of costs that never stop adjusting. Mortgage payments are only one piece. Property taxes adjust with valuations. Insurance prices respond to climate and risk. Maintenance costs respond to labor, materials, and time. When interest rates were low, these pressures were masked. When rates rise and stay elevated, they compound. This is where structure matters. A household doesn't need to default to lose control. It only needs to lose margin. Once flexibility disappears, decisions stop being optional. Selling becomes necessary. Refinancing becomes impossible. Waiting becomes expensive. And when many households reach that point at once, the market changes character. Buyers with access to long-term capital behave differently than families dependent on monthly income. They can wait. Absorb volatility. Scale ownership. This is not a moral failure. It is an asymmetry. The same asymmetry existed between empires and creditors. Between households and institutions. And like before, the transfer doesn't feel dramatic. Homes don't vanish. They change hands. Ownership concentrates. Risk migrates downward. Stability becomes conditional. Once enough households lose margin, the system stops behaving like a market, and starts behaving like an extraction process. Most people expect loss to arrive loudly. They imagine foreclosures flooding the streets. Prices collapsing overnight. Headlines screaming collapse. But that's not how structural loss usually unfolds. Structural loss is quiet. Homes are sold voluntarily. Payments are made until they can't be. Ownership shifts without panic. From the outside, the system appears orderly. This is exactly why people stay exposed longer than they should. There is no clear signal telling them it's time to move. Only pressure. In past cycles, relief arrived quickly. Rates were cut. Credit expanded. Prices rebounded. That history anchors expectations. But expectations are not guarantees. When inflation remains elevated, when policy is constrained, when debt levels are already high, the tools that once provided relief lose effectiveness. The system doesn't collapse. It tightens. Costs remain high longer than households expect. Temporary stress becomes permanent adjustment. And the longer that condition persists, the more ownership transfers without drama. By the time the pattern is obvious, participation is no longer optional. History shows that once a system reaches this phase, the outcome isn't decided by sentiment, it's decided by endurance. Debt does not need to overwhelm all at once to win. It only needs to stay slightly ahead of income for long enough. That is the power of compounding. Small gaps become permanent drains. Temporary strain becomes structural weakness. This is why earlier generations could survive leverage that now feels suffocating. The timeline mattered. The direction mattered. When income grows faster than obligations, debt shrinks naturally. When obligations grow faster than income, debt becomes dominant. The Ottomans experienced this at the state level. Modern households are experiencing it privately. Neither felt dramatic at first. But once compounding turns against you, time stops being an ally. And when time stops working for you, control starts moving away from you. It's tempting to believe that policy will step in the way it always has. Lower rates. Support programs. Market stabilization. But policy operates within constraints. Inflation. Debt levels. Credibility. External pressures. When those constraints tighten, policy shifts from rescue to management. That doesn't mean intervention stops. It means outcomes change. The system prioritizes stability over individual ownership. Liquidity over equity. Continuity over reversal. This is not a conspiracy. It is a hierarchy. And once that hierarchy is in place, ownership becomes conditional rather than assumed. In 1873, a financial panic spread from Europe. Credit dried up. At the same time, drought devastated Anatolia. Tax revenue collapsed. Debt payments didn't. In 1875, the treasury was empty. The Ottomans defaulted. Political support evaporated. Enemies moved in. War followed. Defeat followed. Reparations followed. By the time it ended, the empire was insolvent and defenseless. That's when foreclosure began. Instead of invasion, creditors imposed administration. The OPDA took control. Revenue was seized. Development froze. Sovereignty vanished quietly. Even after the empire collapsed, the debt survived. The new Turkish Republic spent decades paying for obligations created generations earlier. The final payment came in 1954, 100 years later. 4 generations paid the price. This is the blueprint. And it's still being used. Across Africa and Asia through infrastructure lending. Across Latin America through restructuring programs. Through long-term leases, asset transfers, and control without occupation, and now, the same pressure is building inside the United States, not at the national border, but at the household level. Housing debt has become the new empire. Mortgages are larger. Terms are longer. Costs beyond the mortgage, insurance, taxes, maintenance, are compounding quietly. Interest doesn't need to explode. It only needs to stay high long enough. As debt service absorbs more income, flexibility disappears. Forced sales follow. Ownership concentrates. Control shifts. This isn't a dramatic crash. It's a slow transfer. Tens of millions of homeowners are exposed, not because they made irrational choices, but because the structure changed around them. This is analysis, not financial advice. But the pattern is clear. Debt doesn't conquer with noise. It finishes the job silently. The Ottomans learned this lesson over a century. We're learning it in a decade. The debt trap isn't coming. It's already working. The only question is whether you recognize it or not. At that point, the system is no longer trying to save homeowners, it's trying to survive itself. The most dangerous phase is the last one, because it doesn't feel like an ending. It feels like normal. Homes are still lived in. Payments are still made. Markets still function. But ownership has shifted. Control has changed hands. And options have narrowed. The Ottomans still had a sultan when sovereignty was gone. Modern homeowners may still live in their houses when equity is gone. This is not collapse. It is conversion. And conversions don't reverse easily. The debt trap doesn't announce itself. It completes its work quietly. The only real difference between those who lose everything and those who don't is whether they recognize the structure while there is still time to adapt. Not panic. Not speculation. Recognition. Because once the system finishes tightening, recognition no longer changes outcomes. It only explains them.